Welcome to another Accounting Basics video. In this video, we will look at ledgers. Information from the books of original entry is posted to the ledgers. Ledgers are essentially books that contain accounts, and this is where transactions are recorded in their relevant accounts by following the rules of double entry bookkeeping. Double entry bookkeeping means that every transaction is recorded twice, once on the debit side of one account and once on the credit side of another account. For your Edexcel IGCSE accounting exams, you need to be familiar with three main ledgers: the receivables ledger, the payables ledger, and the nominal ledger. We start with the receivables ledger. This ledger is used to keep records of all customers who buy on credit. The information posted to the receivables ledger comes from several books of original entry, such as the Sales Day Book, Sales Returns Day Book, the Cash Book, and the Journal. Whenever a customer buys goods from us on credit, returns goods, pays us money, receives a discount, or when an amount becomes irrecoverable, the transaction is first recorded in the appropriate book. It is then posted to the customer's account in the receivables ledger. It is important to remember that we only keep accounts for credit customers. If a customer pays immediately and does not take a credit period, there is no need for the business to create a personal account for them. These transactions are simply recorded in the cash book. We will now take an example of a credit customer to show how a customer's account is created in the receivables ledger. Let's say Jack is a credit customer. On the screen, you can see the transactions related to him. At the beginning of the period, Jack owed us $400, which is his opening balance. During the period, we sold goods to him on credit, and later, he paid us some money. Now let's see how all these transactions are recorded in Jack's account. First, we draw the account format. We write Jack's name at the top. On both sides, we have columns for date, details, and amount. The left-hand side is the debit side, and the right-hand side is the credit side. We begin with the opening balance. At the start, Jack owed us money, so we write this as balance brought down, or balance BD. But which side should this be written on? To decide this, we need to remember that Jack is a customer, so he is a trade receivable. Trade receivables are assets, and according to the rules of accounting, assets have debit balances. Therefore, we record the opening balance of $400 on the debit side of Jack's account. Next, we sold $120 worth of goods to Jack on credit. To decide which side this transaction should appear on, we need to look at what happens to Jack's account balance. When Jack buys more goods from us on credit, he owes us more money, so his account balance increases. Jack is a trade receivable, and trade receivables are assets. An increase in an asset is recorded on the debit side. Therefore, the credit sale of $120 is entered on the debit side of Jack's account. In the details column, we record the source book, which is the Sales Day Book. Then, Jack paid us the amount he owed at the beginning, which was $400. When Jack pays us money, his account balance decreases. Since Jack owes us less, trade receivables go down. Trade receivables are assets, and a decrease in an asset is recorded on the credit side. So we enter $400 on the credit side of Jack's account. In the details column, we write the source book, which is the cash book, where this transaction is first recorded. Once all the transactions have been entered, we can balance the account. First, we total both sides. The debit side adds up to $520, while the credit side totals $400. Since the debit side is higher, we write the total of $520 on both sides of the account. Next, we find the difference on the lower side. The difference is $120, and this is called the balance carried down, or balance CD. Finally, we bring this balance down to the next period as balance brought down, or balance BD. This represents the new account balance for Jack. At the end of the period, Jack owes us $120, and this becomes the opening balance for the next period. Next, we move on to the payables ledger. This ledger is used to keep records of all suppliers from whom we have bought goods on credit. The information posted to the payables ledger comes from several books of original entry, such as the Purchases Daybook, Purchases Returns Daybook, the Cash Book, and the Journal. Whenever we buy goods from a supplier on credit, return goods to a supplier, pay them money, or receive a discount, the transaction is first recorded in the appropriate book of original entry. It is then posted to the supplier's account in the payables ledger. It is important to remember that we only keep accounts for credit suppliers in this ledger. If a supplier is paid immediately and no credit period is taken, there is no need for the business to create a personal account for them. Such transactions are recorded only in the cash book. Now, let's take Jack as a supplier and keep the values the same. If Jack is a supplier, he is a trade payable, which means he is a liability for the business. Liabilities have credit balances, so Jack's opening balance is recorded as balance brought down, or balance BD, on the credit side of his account. Next, we bought $120 worth of goods from Jack on credit. This means we now owe him more, so his account balance increases. Since trade payables are liabilities, and an increase in a liability is recorded on the credit side, we enter $120 on the credit side of Jack's account. In the details column, we record the source book, which in this case is the Purchases Daybook. Then, we paid Jack the amount he was owed at the beginning of the period. When we pay a supplier, the amount we owe them decreases. This means the liability goes down, and a decrease in a liability is recorded on the debit side. Therefore, we record this payment on the debit side, with the cash book as the source. After recording all the transactions, we balance the account. We identify the higher side, write the higher total on both sides, and then find the difference on the lower side. This difference is called the balance carried down, or balance CD. We then bring this balance down, as balance BD in the next period. This represents what we owe the supplier at the end of the period, and it becomes the opening balance for the next accounting period. After the payables ledger, we move on to the nominal ledger. Apart from customer and supplier personal accounts, almost all other accounts, such as sales, sales returns, purchases, purchases returns, and many others, are created in the nominal ledger. The cash and bank accounts do not require a separate ledger, as these are recorded and balanced in the cash book. To help you decide whether an entry should be a debit or a credit, here is a simple rule you can use. Assets and expenses are debited, while liabilities, income, and capital are credited. You can use this rule to post transactions to the correct side of the ledger accounts. I hope this was helpful. I'll see you in the next Accounting Basics video. Thanks for watching.